Good evening. On Friday, the Department of Justice served the Federal Reserve with grand jury subpoenas, threatening a criminal indictment related to my testimony before the Senate Banking Committee last June. That testimony concerned, in part, a multi-year project to renovate historic Federal Reserve office buildings. I have deep respect for the rule of law and for accountability in our democracy. No one, certainly not the chair of the Federal Reserve, is above the law. But this unprecedented action should be seen in the broader context of the administration's threats and ongoing pressure. This new threat is not about my testimony last June or about the renovation of the Federal Reserve buildings. It is not about Congress's oversight role. The Fed, through testimony and other public disclosures, made every effort to keep Congress informed about the renovation project. Those are pretexts. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the President. This is about whether the Fed will be able to continue to set interest rates based on evidence and economic conditions, or whether instead monetary policy will be directed by political pressure or intimidation. I have served at the Federal Reserve under 4 administrations, Republicans and Democrats alike. In every case, I have carried out my duties without political fear or favor, focused solely on our mandate of price stability and maximum employment. Public service sometimes requires standing firm in the face of threats. I will continue to do the job the Senate confirmed me to do, with integrity and a commitment to serving the American people. Thank you.
Federal prosecutors have launched a criminal investigation into Federal Reserve Chair Jerome Powell. Government officials say the probe is related to Powell's testimony last summer about the central bank's building renovation project. Powell responding in a video statement saying it's part of President Trump's continuing campaign to pressure the Fed to lower interest rates. Our Federal Reserve correspondent Jennifer Schonberger is joining me now with the latest. And just an extraordinary turn of events, Jen, especially at a time when it seemed like tensions between the administration and the Fed chair had abated to some degree. And of course, Powell, right, he's a lawyer. He's a very plain-spoken and sort of soft-spoken guy. But it's pretty clear from this video that this is a strong statement.
Very strong reaction from the Fed chair last night, Julie. That's right. Just to recap what you said, Fed Chair Jay Powell facing a criminal investigation into his testimony before the U.S. Senate this past June when he made comments about renovations of the Federal Reserve's headquarters here in Washington. In an extraordinary video message, Chair Powell revealed Sunday night that the Justice Department served the central bank Friday with grand jury subpoenas threatening criminal indictment related to Powell's testimony before the Senate. Powell suggesting this action isn't so much about his testimony as it is about a difference of opinion in interest rates, which threatens central bank independence. He stressed what he called, quote, unprecedented action that should be seen in the broader context of the administration's threats to the central bank. Take a listen to Chair Powell.
The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the President. This is about whether the Fed will be able to continue to set interest rates based on evidence and economic conditions, or whether instead monetary policy will be directed by political pressure or intimidation.
Now, President Trump has denied any knowledge of this investigation, telling NBC News in an interview Sunday night that, quote, I don't know anything about it, but he's certainly not very good at the Fed, and he's not very good at building buildings. When asked whether this was pretense to try to pressure Powell to lower rates, Trump said, no, I wouldn't even think of doing it that way. What should pressure him is the fact that interest rates are already too high. Powell said in his video message that over the course of 4 different administrations spanning both Republicans and Democrats, he has always moved to set interest rates solely on the congressionally mandated goals of maximum employment and price stability, and will continue to do so. Julie?
And Jen, it's interesting because if Trump is trying to get Powell to lower interest rates, it seems like that this could backfire in various different ways. We know that Powell is done in his term as Fed chair at the end of May. He might stay on, though, still as a member of the Federal Reserve. So there are questions about whether this would sort of sway him to stay on. You also have Senator Thom Tillis, who is a Republican from North Carolina, who is going to be leaving office, that he is not going to approve any of President Trump's appointees to the Fed while this is all going on. So there's a lot of questions now about what ripple effect this is going to have.
Absolutely. And you're seeing that today in the markets with bond yields. If it is that Trump wants lower interest rates, then you do need lower yields on treasuries. And if there is a question about central bank independence, that indeed is going to backfire. At this point, Chair Powell has really held restraint in responding to the president, trying to keep tensions cool. The fact that he came out with this video message, of course, coming after unprecedented action from the administration, almost feels like both sides are in an all-out war. The question now is whether Treasury Secretary Scott Bessent, who has sort of been the adult in the room, moves to sort of cool tensions, or whether Republicans in Congress create some sort of an off-ramp here. You mentioned Senator Thom Tillis. He is one who has said, hey, I'm not going to support whoever the next Fed chair is, because frankly, this action from the administration is a warning shot to whoever the next Fed chair is going to be. And all of the different candidates, from a National Economic Council Director Kevin Hassett to former Fed Governor Kevin Warsh, who are supposedly the top two picks, have said they will indeed move and support central bank independence. But this is sort of a shot across the bow, which is, if you don't do as I say, I will move to bring criminal charges to push you out so that I get what I want. And so this is a very interesting, shaky moment here for the central bank, for our country, for financial markets. And we're going to have to see how this plays out and if we see cooler heads prevail.
It's interesting. We've been watching the poly market odds on both the next Fed chair and some of the other questions around it. There is not a broad expectation that Trump is going to be successful in pushing out Powell. Although, to your point, it doesn't matter if there is this threat hanging over the head of the next Fed chair. And in terms of the odds on the next Fed chair, Jen, it still remains Hassett. But, at this point, they keep teasing, the White House keeps teasing that we're going to get this at some point. We're going to get the actual news. Any new indications on that front?
Not at this point, but I will say it's interesting to see whether Fed Chair Jay Powell will indeed not just step down as chair in May, but whether he steps down as governor, because his term is not up until 2028. So the question is, does he feel that he needs to stay on board in order to protect central bank independence? And are there other members of the FOMC who are going to coalesce around Chair Powell right now? And whenever the new Fed chair comes in, creating some pushback there. We already know there are a number of hawks on the committee right now who do not support lowering rates further. So this is going to be interesting to watch.
Yeah, we're going to talk to Jason Furman much more about this in the next hour. Jennifer, thank you very much. Appreciate it. Concerns about the central bank's autonomy reigniting the Sell America trade for now. Joining me now, Keith Lerner, Truist Chief Investment Officer and Chief Market Strategist. Keith, it's good to see you. In your most recent note, there is one sentence that stood out to me, given the events of the past couple of weeks. You said, flexibility and tactical awareness are essential for 2026. That might be the understatement thus far of 2026 on the flexibility front, for sure. And we do have more news hitting today, as we talked about, in the form of these threats to Fed independence. So how do you stay flexible? How do you respond to a news item like that?
Yeah, well, first, Julie, always great to be with you. And you didn't mention it. In our outlook, we called it the seventh inning stretch. But we also said you'd also see some curveballs, and those curveballs you don't know sometimes that they're coming. And you can argue we've had two curveballs already with the situation in Venezuela and now with what's going on with the Fed investigation as well. So, and we're in a midterm election year. And historically, the one thing that we pointed out to our our investors. In a midterm election year, you tend to have a pickup in volatility because of some of potential changes along the way. So to your point, that's a long way of getting to your point about staying flexible. I wouldn't overreact to any one headline, right? But it does suggest that we have to pay attention to this. And this upcoming earnings season that's coming up, which is going to be crucial because to us, even though we've had all these different concerns over the last year, earnings have been key. So we're not making any substantial changes yet, but we're obviously monitoring the situation closely. And I think diversification is key.
Diversification key here, but are there implications for rates? And would there be signals that the market was sending that would indicate that there is a rising fear that Fed independence will be challenged and that there's less credibility when it comes to setting interest rate policy?
So some of the things that we're looking for around the concerns or questions about Fed independence is the bond market reaction and inflation expectations. So, and also the dollar. And what are we seeing today? Well, we're seeing a modest shift in each of those. The 10-year, it's up about 3 basis points, so not severe, but it is moving up. You are seeing the U.S. dollar weaken about 40 basis points as well, and you're seeing gold up. So what does that say to us? Well, one, we've been positive on gold all last year. We still see the benefits of having gold as a diversification in a portfolio. We still think that makes sense. And even though we still maintain this modest U.S. overweight, we've been increasing our international exposure over the last year. And one way the international markets benefit is if the dollar weakens and the local currency increases, and you're seeing that today. So that's the way we're thinking about the world more generally. And I would say, lastly, we've been Team USA for several years. We've been bringing that in because of several developments, and this just reinforces that global diversification is really key.
So in other words, Keith, it's not as though you're saying, jumping on the quote unquote sell America trade per se, maybe lighten up on America or rebalance a little bit towards international. In other words, maybe a little bit more nuanced than just the sort of sell America trade.
Yeah, and the way I think about it is, we're not making the changes because of the headline today. I would say relative to where we were 18 months ago, we have more international than we had before and a little bit less U.S. than we had before. But we still have that tilt. And also, when we have news headlines like this, I also don't want to get lost of other factors that will matter. I mean, like I said, the earnings season, the AI theme is still alive and well. I mean, just over the weekend, you saw this announcement by Walmart with Gemini, and Walmart stock's up 3%. That's not a recommendation on Walmart, but it's just saying, hey, this AI theme and this move to adoption is going to be really important. And ultimately, earnings drive the stock market over time. So I just don't want to, this matters, but it's not the only thing that matters. And corporate profits, I would say, over time matters more.
And Keith, I'm glad you talked about corporate profits because I want to get your take on the gap between that tech earnings growth and everything else, or put another way, sort of growth versus value, which is that debate's come back into the fore recently, right? We've seen values start to creep up a little bit. And I know the expectation is the growth still expected to outperform value, or tech's expected to outperform in terms of earnings, but the gap's closing a little bit. Is that enough of a justification to see continued gains in some of those value stocks?
Yeah, the way we're thinking about this is kind of similar to the U.S. international story. We still like tech and communication services long term. Those are legacy positions. But I think it's not either or. I think it's both. I think unlike in the past where it seemed like the tech trade was it, what we've done in our sector strategy over the last couple of months is we went to a overweight in industrials, which is more of that global kind of uptick in the economy. And then we also upgraded healthcare as well. And then more recently in December, we were underweight energy and materials. We upgraded those as well. So I think this broadening trade, which it seems like everyone talks at the beginning of each year and it hasn't worked out, we're actually seeing it actually start to work out. And the difference this year, or heading into this year, we're seeing those earnings borne out as well. So it's being supported. So I would just say it's a combination of both, but I would not get rid of your tech at this point. I just think there's more opportunities beyond tech is the way I would think about it.
The broadening maybe has finally arrived. Keith,
maybe.
Thanks a lot. Appreciate it. Good to see you.
Thank you. Great to see you as well.
Thanks.
The bedrock of the Federal Reserve is its independence to make decisions on interest rates. Challenge that, and the bedrock begins to crack. And then that could spread to the financial system. You do not want cracks in the financial system, obviously. The bedrock of said financial system is trust. Trust the Federal Reserve is independent and trust in transactions. If trust begins to erode, well, replay what I just said, rewind it back. Whether one likes it or not, the bedrock of the U.S. financial system is debt. It's how the economy runs. Investors all around the world trust the U.S. government will make good on its debt obligations. If global investors lose trust in the ability to service debt, in part because of a view of a less credible Federal Reserve, it will raise the cost of capital for the U.S. and many companies. That sets off a series of ugly dominoes one would rather not see pushed over. You just wouldn't want to see it. Let's bring in the opening bid roundtable to weigh on all of this, really an unprecedented day. Matt Stuckey, Northwestern Mutual Wealth Management Chief Portfolio Manager of Equities, alongside Yahoo Finance Fed Correspondent Jennifer Schomburger and Senior Reporter Inez Ferre. Jen, I want to come out with you here. Really a situation, like I mentioned in the intro, not a lot of folks have seen before. I think they're trying to figure out, one, what exactly happened here? And then number two, what is next in this?
Yeah, so this looks like a way for the administration to pressure the central bank in a very unprecedented way to lower interest rates. And you saw Chair Powell come out in an extraordinary recorded video message Sunday night, essentially calling that spade a spade. So what comes next is, does the investigation now, or does the grand jury bring criminal charges against Chair Powell? It hasn't been said who is going to lead this investigation here in Washington, but there is a sense that it could be the U.S. Attorney Jeanine Pirro, who is an ally of President Trump, and she sure does not mess around. And so if she is in charge, I would expect charges to be brought against Powell, probably on some sort of technicality. Now, the issue here is that the administration wants lower rates, therefore they're trying to push Powell out. However, that could backfire because we're already seeing reaction this morning in the bond market. It could also make Chair Powell dig in his heels further. While his term as chair is over in May, his term as governor is not over until 2028. So that begs the question, will he stay on through 2028? And that means then the president has less openings to appoint a new Fed chair. He would basically have to use Governor Myron's spot to then appoint a new governor and then elevate that person to Fed chair. So then that also begs the question of, hey, if there's an issue with Fed independence right now under Chair Powell, does that continue under the next Fed chair? This is sort of a warning shot, which is, if you don't do what the administration wants, will you face a criminal investigation? And that means that every single inflation report that we will be getting takes on that much more importance.
Matt, you are the money person on this panel. Question one to you. Do you sell America off this?
No, I don't think you do. I think the sell-off this morning is a little bit of a reflection of kind of where valuation multiples are and kind of where credit spreads are. We're at near 15-year tights in terms of where credit spreads sit today, meaning that there's not a lot of systematic risk priced into the equity market. And you get a headline like this over the weekend, and there's going to be some adjustment to that valuation. But there's a lot of positives still with the U.S. economy. Earnings are rising across the equity landscape, from small caps all the way up to large caps. And we're heading into earnings season where we're likely to see another quarter of double-digit earnings growth year on year. And so those are positives that I think can counteract some of the, let's call them, somewhat, discouraging headlines that we've seen over the weekend.
Question two, Matt. Folks that I've talked to on this in the past, in the morning so far, have pointed out a potential rise in inflation expectations on the view that the Fed's independence is now in question. If that's the case, if we're going to get a rise in inflation expectations, what stocks work and what won't work?
Looking at the longer term risk, you just underlined it well there. The loss of independence from the Fed kind of comes with an unanchoring of inflation expectations. On the positive side, what you've seen in markets the last couple of months is inflation expectations moving lower, as we've seen some of the outlook for inflation improve as some of the tariff headwinds have been less than expected. But if you're looking at a way to hedge the upside to maybe that changing if inflation expectations were to rise. Real assets are your hedge there. So think commodities, think energy stocks as a way to kind of hedge some of that inflation risk if it were to reverse and head the opposite direction.
And it's almost as if the markets sniffed all this out. Those investors in hard assets like gold, silver, commodities, they almost sensed this was coming. I mean, of course they didn't, but you know what I'm trying to say. So gold, to that end, has caught another bid today.
Yes, and metals bulls are saying that it is going to go higher. I mean, you're seeing commentary about this being an assault on the Fed. This is destabilizing, and that's why you are seeing investors flocking to safe haven assets. So you're looking at gold at all-time highs. You're looking at silver also that has been rallying hard. And for the first time, just want to point out, since 1996, you've got foreign central banks that are holding more gold than U.S. Treasuries. And I saw one strategist saying the debasement trade is real, that debasement trade that we were talking about last year. And keep in mind that these moves that we're seeing today are on this question of Fed independence, but also you are seeing geopolitical tensions, which have also been feeding into the precious metals rally. You had HSBC just days ago saying that gold could reach 5,000 because of, in the first half of 2026, because of geopolitical risks and rising debt. So now gold is not just trading as an inflation hedge, but it's also trading because of these geopolitical tensions as well.
Jen, one of the first things I thought of when I saw this news cross, and it was late, you got that alert. This is the last thing you want to see late Sunday, this type of alert cross the screen. But my first thought among many was, wow, this is Kevin Hassett's job.
That's what Polymarket has certainly been pricing in, and I think that's what investors have been pricing in really since the get-go. So I don't think any surprise there, but to your point, yes, the president wants somebody in the Federal Reserve Chair spot that he trusts will be loyal to him. And so Hassett would obviously fit that. He has said, the president has said that he is in the top two. He likes the two Kevins. The other one is former Fed Governor Kevin Warsh. The president expected to make an announcement either before he heads to the World Economic Forum in Davos on January 21st or right afterwards. So we'll see how this plays out.
Jen, you've been covering the Federal Reserve for years. Have you ever seen a Federal Reserve video statement like this before?
No, I was shocked last night when I was alerted about this message. And to even be in this situation is completely unprecedented. I don't think we have really seen this in the modern era whatsoever. It seemed that Chair Powell had tried in the past to sort of quell some of the president's threats, the administration's threats. The fact that he came out with such a strong statement and on video nonetheless was really a shot across the bow. It almost feels like we are in an outright war at this point. Typically, Treasury Secretary Scott Bessent has sort of pushed the president to ease back a bit on this. Now, the president has denied any knowledge of this, the grand jury subpoenas. And Kevin Hassett said this morning that he doesn't believe the president has been briefed on it, which is quite interesting. Nevertheless, this is an unprecedented moment. We'll see if Bessent or other Republicans in Congress come in and sort of take an off-ramp here, if you will, to sort of quell things down. Because to your point, as you mentioned earlier in the show, central bank independence is really the bedrock of a strong economy. And if you don't have that, then you're going the way of, dare I say, Venezuela or Iran.
Oh, wow. All right, well, we don't want that, Jen. Matt,
that's a far-fetched scenario.
Yeah, no, but I get it. I hear where you're coming from. It's just a lot of things going on Monday. Matt, my question to you is this. Is a loyal Fed chair good thing for investing? A Fed chair that is loyal to the president, essentially.
The best Fed chair is one that has the interest of the economy in front of us for the American people, and that means a long-term North Star of keeping inflation expectations anchored around 2% and maximizing full employment for Americans. And so that's I think going to continue to be the goal of the Fed. And as a reminder, the chair is just one voting member. There's a variety of different members on the board.
Matt, do you think this news could be the start? And we never know until after it happens, but this is that event that causes a rolling correction in markets. Bond yields higher, flight to safe haven assets like Inez mentioned in gold, and then equities have to adjust for this higher risk premium.
No, I don't think so. I think the earnings power of corporate America continues to strengthen, and we've seen that strengthen since the second quarter of 2025 and accelerate into year end. That would have to reverse in my mind for that cascading effect for a downward move in equities, and that's just something with earnings season in front of us that I don't think is a high likelihood.
Inez,
Brian, could I just add?
Go ahead, guys. Go ahead.
I just wanted to add a quick comment, which is, we're so concerned about central bank independence this morning, given the actions that we learned about overnight. However, if Chair Powell were to stay on as governor, perhaps the rest of the FOMC coalesces around Chair Powell and sort of tries to protect central bank independence. The same thing if we have a new Fed chair, when we have a new Fed chair come in, does the rest of the FOMC really stand in division with that chair? We know there are a lot of hawks on the committee, so let's recognize that this is a 19-member committee. This is not a committee of one.
No, that's a really good point, Jen. And Inez, really key to the market rally over the past few years has been the FOMC has been, they've rallied around the Fed chair. I mean, that's been key to the investment thesis.
Yeah, completely. Look, I think what Powell did on Sunday night was basically call checkmate on Trump. And so this has been sort of calling into this question the Fed independence. But Wall Street has also been talking about this over the last year and also putting into the expectations for what will happen with the markets. Look, you still have the AI trade. You still have tech that's supposed to power. You still have earnings. You still have strong balance sheets. So we have to take everything into an entire consideration. But that doesn't take away the question, of course, of Fed independence and what this means for assets like the metals markets, like we've seen.
This was great analysis on a very complicated situation. Big thanks to the opening bid roundtable. Appreciate it.
The Federal Reserve is facing what Chair Jerome Powell calls an unprecedented action. Powell revealing Sunday night that the Justice Department served the central bank with grand jury subpoenas, threatening a criminal indictment related to Powell's testimony before the U.S. Senate. For more on the power dynamics at play, let's welcome in Jason Furman, Harvard Kennedy School of Government professor and a former Council of Economic Advisors chairman under President Obama. Jason, thank you so much for being here. And I know you've signed on to a statement with some former Federal Reserve and other government officials emphasizing the importance of the Federal Reserve's independence. But I just want to take a moment and just get you to react to what we have seen in the last 24 hours, because it is so unusual, to say the least.
Yeah, Jay Powell did not want to get to this place. His statement last night was enormously powerful, precisely because he has stuck to his knitting, continued to do his job, not fallen for any of the debate. This is bait. This is not a resistance lib. This is a person doing what he needs to for the sake of the United States economy and our country more broadly. And I think he's going to win.
And is that belief, do you think, why we're not seeing more of a reaction in the markets? Or is it just because markets don't react necessarily to this kind of stuff, Jason? What do you think?
Yeah, I think this is backfiring. You saw Senator Tillis's statement. This is going to complicate President Trump's ability to get his person on the Fed. It's going to increase the likelihood that Jay Powell stays on as governor. I don't think courts and juries are going to go along with this. And for the members of the FOMC, it's going to make them want to stand up and show their independence too. So this is a very, very serious threat, but the Fed is a real testament to its success, and widespread acceptance and belief in that success, I think, will prevail.
Jason, do you think that Powell will stay on as a Fed governor after his term as chair expires, in part because of this?
I think it makes it much more likely that he'll stay on. And it would be a real sacrifice. It can't be fun moving from chair to governor. It can't be fun being at the Fed in the current environment. But unfortunately, it may be what he feels he needs to do. Every vote at the Board of Governors is critical. 4 out of 7 of them can remove any of the Reserve Bank presidents. It's, at some point going to become a matter of counting votes.
And Jason, recently you wrote in the New York Times just about the sort of dynamics at play, not just with the Federal Reserve, but economic policy more broadly, and the president seeing some challenges to, from tariffs to his attempts to remove Fed official Lisa Cook from the board. So where do you think we land now in the wake of this latest action in terms of kind of unified economic policy and where we are?
Yeah, my argument in that piece was that we basically had seen peak Trump. That last year, sweeping fiscal actions, sweeping actions on tariffs, sweeping actions through DOGE, and that we're just not going to see more of that. Now, he's going to try. He tried on interest rates with credit cards. He's trying now with Jay Powell. He's not somebody that's going to fade into the distance. We're going to be seeing and talking about him each and every day. But his ability to get things done depends on the courts, it depends on Congress, it depends on the law, and all of those are increasingly going to be skeptical of him, and I think that's what we're going to see on this particular action on the Fed as well.
And Jason, we have inflation data coming out this week. We have CPI coming out on Wednesday. And so setting aside economic policy for a moment, what's your assessment between the jobs report we got last week and what you expect for inflation of the economic backdrop right now?
Look, I was in Europe last week and they posted a 2.0% inflation. They're feeling mission is accomplished. Here in the United States, the mission on inflation is definitely not accomplished. It's a lot closer to 3 than it is to 2. GDP growth looks to be very strong. I think most of the weakness of the job market is on the supply side, not the demand side. So it's not something the Fed can solve. So to me, the risks remain tilted towards inflation, and policy should continue to be in a contractionary stance to deal with that.
So the Federal Reserve policy can't do anything, but on that front, on this sort of affordability front, which is the buzzword of the moment, the White House has been trying to make some attempts to address that, particularly on the housing side, saying Fannie and Freddie should be buying more mortgage-backed securities, saying that there shouldn't be private ownership of single-family homes, institutionally. Do you think any of those moves are the right ones, are in the right direction in attacking affordability?
Right. I mean, things like private equity owning homes will do about as much as spitting in the ocean will do about sea level. The big affordability issue that the president could solve is the tariffs. They're raising the price, including in housing, of construction materials. They're making it more costly to build houses. That's where he should start on affordability.
Are there any other measures that you think he could be taking besides the tariffs? I mean, one could argue that the tariffs aren't necessarily the only reason that we've seen inflation be persistent.
Oh, yeah, no, it's not. I mean, a lot of this inflation was set off 5 years ago by grossly excessive fiscal policy. One of the things that we worried about at the time was that it would perpetuate itself, where wage growth leads to price growth leads to wage growth. Unfortunately, the main way to address that is with tighter monetary policy, which is a bit unpleasant, but something our economy is more than robust enough to withstand, what with all the data center investment, booming consumer spending, and overall demand strength. So the Fed is central, but if the president wants to help out, he could get rid of the tariffs.
Well, it doesn't look like that's going to happen, Jason, on that front. What do you expect the Supreme Court to do on the tariff front? And it seems like even if they remove some of the tariffs, the administration has prepared other measures to keep some of them in place.
Look, it is partly happening, right? On things like beef and coffee, where it's incredibly visible and really hard to explain, the tariffs have come down. Some of the increases, like on furniture, have been canceled. So I think even the administration itself, while they claim the tariffs are paid by foreign countries, when push comes to shove, they're going to be pulling back on them. I hope the court invalidates a large swath of them. I think the administration could bring some of them back through other means. I don't think they could bring all of them back. And I don't think it's going to be in their interest to be raising tariffs. I think we're just going to see them, either because of the court, the administration, possibly, but much less likely Congress, tariffs going down, not up from here.
Jason, good to see you. Thanks a lot for your perspective.
Thanks for having me.
White House Press Secretary Caroline Leavitt said earlier today that President Trump did not direct the Justice Department to investigate Fed Chair Jay Powell. Speaking with reporters earlier at the White House this afternoon about whether she could provide assurances that Trump's criticisms had nothing to do with the investigation, Leavitt told reporters, quote, "The president has every right to criticize the Fed chair. He has a First Amendment right, just like all of you do. And one thing is for sure, the president has made quite clear Jerome Powell is bad at his job. As for whether or not Jerome Powell is a criminal, that's an answer for the Department of Justice." Now, as you know, tensions between Powell and Trump have been bubbling since the first day that Trump took office for his second term. Unhappy with how high rates were, Trump threatened to fire Powell, touching off a major sell-off in markets that ultimately caused the president to back off of that threat. However, tensions started to bubble up again over the summer months when the administration and Republicans seized on Chair Powell's testimony before the Senate Banking Committee this past June on comments made on renovations of the Fed's headquarters here in Washington, suggesting that perhaps Powell had mischaracterized the nature and costs of the renovations to lawmakers. Then, in a rare visit to the Fed's headquarters in July, Trump donned a hard hat and toured the construction site with Powell as the two disagreed publicly about the cost overruns. Trump famously at the time saying that the Fed was over budget, running at $3.1 billion, something that Powell disputed right there on the spot. Now, things seemed to cool a bit over the fall as the Fed embarked on 3 consecutive policy meetings of rate cuts as there were concerns about the nature of the labor market and as the impact of tariffs on inflation were better than feared. However, once December 30th rolled around, it seemed clear that the president was still unhappy with Chair Powell and the Fed, threatening to sue Powell. Fast forward to Sunday night when Chair Powell revealed that indeed a grand jury was opening a subpoena and an indictment, a criminal indictment, into Chair Powell as of January 9th.
Alan, unprecedented seems to be the word that everyone is using, especially that video alone being unprecedented in itself. What sort of risk is this to the Federal Reserve's independence?
Well, it's a real risk. I mean, who knows how far this will go in the judicial system. It would be nice to see it disappear very quickly, as some of the Trump administration's other forays have. But there's certainly no guarantee of that. And this really raises the war between the Trump administration and the Federal Reserve to an entirely new level. Criminal. Think about that word, criminal. What in the world could he actually mean? Cost overruns? That's criminal? I wonder how many builders have had cost overruns. So, given the background which you showed in that clip of Jay Powell, there's every reason for the Federal Reserve to be very wary of this and take it seriously and, to your point, respond.
Yeah, and a group of former Fed officials, including Janet Yellen, Ben Bernanke, called this unprecedented. But they also went on to say that this is how monetary policy is made in emerging markets with weak institutions, with highly negative consequences for inflation and the functioning of their economies more broadly. What do you make of that statement? And also, it's worth pointing out that they posted that statement on a Substack.
Well, I don't know about the latter, but the statement itself is indicative of the fact that in many less developed countries, not all for sure, but in many, but not in developed countries, at least in recent history, monetary policy is made by politicians, not the kind of technocrats that run the Federal Reserve, including, of course, Jay Powell, but also including everybody else on the Federal Open Market Committee. And the evidence shows that when you leave monetary policy to technocrats who are not trying to push the program of one political party over the other, it's not their job. They know it's not their job. You get better economic policy than you do if you leave it to politicians. There are some very recent examples of both, like Turkey. I mean, Turkey politicized its monetary policy, got huge inflation, and then Mr. Erdogan decided that was a bad idea and we better put in somebody else. So that's the same country going both ways.
Alan, we are expected to get a new Fed chair pick. Reportedly, President Trump having conversations with BlackRock's Rick Rieder this week. We also have Kevin Hassett as potential Fed picks. Moving forward, how are you viewing these potential candidates for the Fed? And if there's a more dovish pick, what does that mean moving forward?
Well, unfortunately, for answering your question, I don't know Mr. Rieder at all, and I don't know his views on monetary policy. I do know President Trump's views on monetary policy, and he wants much, much lower interest rates, recklessly lower. Look, you could have an argument right now and be a legitimate argument that say interest rates ought to be 50 basis points lower than they are. I don't happen to believe that, but it's not a crazy view, and a sensible person could believe it. But 1% interest rate? That is a recipe to raise inflationary expectations, and ironically, therefore raise long-term interest rates, not lower them, which is what the president seems to think.
I do quickly want to get your take on this, because we are seeing Senator Tillis, he's a Republican from North Carolina. They're going to be leaving office, but they said that they plan to block President Trump's picks until this investigation is sort of put behind them. We also heard from Senator Lisa Murkowski saying that Senator Tillis is right for making that move, for blocking potential candidates. What could this mean as we try to name the next Fed chair?
Well, it could mean a delay. It could mean a long delay. There's no predicting that. And by the way, unless I'm missing the law, if there's a delay, Jay Powell can stay in his position. That's come up before, not for chairs, but for members of the board, that the Senate has not confirmed the replacement, and that person, this has happened several times in history, stays in place until replaced.
I mean,
ironically, that could leave Jay Powell in the chairmanship longer.
Alan, what's interesting here, too, is that Fed chair's his term ends as chair in May, but he'll stay on as a governor, from what I understand, through January of 2028.
He could.
So what sort of implications does that have? Is Fed Chair Powell just going to stay in this position and perhaps propose opposition within that seat?
Well, he hasn't said anything about staying on. There's been speculation about him staying on. Previous chairs, when their term ends, have not stayed on. Well, it happened once, excuse me, in the early days of the Fed, but I think only once. As in any organization, when the number one's term ends, he or she usually leaves rather than hang around as number 2, 3, or 4. If Powell decides to stay, the reason, of course, would be to deprive the president of the ability to replace yet another member of the Board of Governors. As you pointed out, he's a member of the Board of Governors in addition to being his chair, and that term as a member of the Board of Governors lasts several more years.
Let's start right there, Thomas. This criminal investigation into Fed Chief Jay Powell. You saw Trump going after Powell again today hard. Do you look at this, Thomas, and you have concerns about Fed independence, or do you think, this is Trump? This is headlines, social media posts, huffing and puffing, but it'll blow over?
Well, I think it is a little bit of, maybe a lot of huff and puffing right now. I think the main point is right now that it is dying down. It was a big announcement as the chairman came out after receiving the subpoenas. and announcing it. As people have rallied around him, it's become less on him and more on the administration. It depends on how much this goes forward, what factors come into play. But I think for the most part, it's a road to nowhere, and we'll see how that plays out in time. I think in the meantime, the focus should be on the economy, and I think that's what the markets have, for the most part, decided.
Well, I want to get your views on the macro, Thomas, but one more question about this, because there were these comments from BNY's CEO, and I thought they were interesting, per Bloomberg, saying these attacks on the Fed counterproductive to the White House's own goals of boosting the economy and prioritizing affordability, saying questioning one of the tenets that underlies the bond market runs the risk of actually doing the opposite of that. What do you make of that? Potentially, is it counterproductive for the Trump administration?
Well, I think it can be, certainly, and it appears that it has been, and that is when you bring greater uncertainty into the picture, and this is what the subpoenas have done, you get people less confident, the markets become less stable, is a usual rule, and therefore you interfere with the very goals that you're trying to achieve. And I think it's important to recognize that the Fed has, in fact, been easing. It's eased 3/4 of a point here in this last 3 meetings. They have a strong incentive, it appeared in the last meeting, to focus on employment or unemployment over inflation. So they had things going to where the Fed was actually, I think, going the way the administration wanted, with easing policy. And you had the prospect of a new chairman over the next several months, through May at least, when Powell leaves. Now this has become a little more fuzzy, as different senators have said, until this is resolved, we're not going to confirm anyone else. So it has thrown kind of a monkey wrench into the game, and I think that's unfortunate for everyone.
Switching gears, Thomas, the CPI print this morning, softer than expected. I'm curious to get your take, Thomas, and what you think the inflation trajectory looks like from here.
Well, you said that they came off softer than expected. I was expecting around 2.8%. This is close to that. It's well above the 2% target. It's been running between 2.7 and 3% for the last year. So I think inflation is still an issue. It has been kind of set aside. I think it's, even though they say that 2% is still the goal, they've kind of implicitly accepted 3% for now as they focus on unemployment. And I think that also may bode for inflationary problems down the road. They'll just have to watch it and be careful, because if they let inflation get out of hand and move above 3% as they pursue stronger employment numbers, I think they could find themselves with both higher unemployment, and higher inflation. So they need to be focused.
Is your bet, Thomas, that they stand pat at this next meeting?
As you look at it with the issues of a soft labor market, but yet inflation higher, and the economy being fairly strong right now, the third quarter was strong, looks like the fourth quarter, and when you put all this together, with the real interest rates less than 1%, there's a very good case for holding pat and waiting and seeing how the winter and then the early spring plays out before you make your next decision on whether to move up or leave them unchanged, or even move down if that becomes an issue later.
I'm curious, Thomas, how do we reconcile this economy, which is resilient, with this cooling labor market? What explains that, Thomas, and does that continue in your opinion?
Well, part of the labor market is politics, in the sense that immigration has been, really an issue in this country. Secondly, tariffs, while they're mitigated, they're not as nearly as disruptive as people were afraid of. They're still slowly having an effect. We've seen that in the manufacturing sector. So that's part of the issue. One part of the issue. The other is there's still a lot of fiscal stimulus. We still, as a country, we're increasing our deficit every year. We have a deficit every year of $2 trillion. That's a lot of stimulus, and a lot of money coming into the economy as the Fed monetizes some of that debt. So that brings inflationary pressures down. And so that's why you have this very kind of difficult economy to reconcile. But the economy overall has remained resilient because of strong fiscal policy, strong monetary policy, and that's, I suspect, will continue at least through the election this year.
The meme stock community they're out in force, really supporting Jerome Powell. Are you surprised by that?
I'm not. It's kind of like the whole underdog mentality, and I love it. And just think about how many times in history you can go back for a long time and see how many Fed governors or Fed chairmen, receive support from the meme stock community or the trader community. It's not a lot. So this is a really rare thing, and I think it's kind of cool to see because he would be the least likely hero, for a bunch of young traders. So I kind of think it's cool. I like it.
But he's put a lot of money in their pockets. I mean, rates have been. Look, I'm not saying he has gotten everything right, but by and large, like I mentioned at the top, the market's been up and to the right since he has taken over as chair.
No question about it. There's not a person under 35 that has even experienced a downtick in 15 years. So, or maybe even longer, 16 or 17 years. So, when you start to think about it, the answer is yeah. There's no reason not to love the guy. If you just entered the market 15 years ago and you're, less under 40, you're damn straight. He's been daddy. That exactly.
Big Daddy Powell. Tom, look, nothing goes up in a straight line. I think it was Claudia Sahm, who we had earlier on one of the shows this morning, saying that there could be a chaotic transition from Fed chair to Fed chair when Powell eventually rolls off I believe in May. Is now the time to start preparing for more volatility in the markets, or do you wait for the final day before Powell is ushered out?
Well, I think it may be the time to start. This is kind of a buy the rumor, sell the news type thing. And I think that it's an interesting spot to start getting long some bonds because I think you could see a flight to quality if you see a pump up in volatility. But I do think that the next Fed chair, if it's somebody that is deemed to not be very independent, it's somebody that's, in Trump's pocket, that will not be a good sign for the equity markets at all. People will not like that.
And as I'm really interested to see what trial balloon now the Trump administration tosses out. You've had two of the biggest bank executives come out here this morning and say, we want Fed independence. It's important to bond markets. It's important to bringing down costs in this country. And sure, the bond markets have barely moved in response to this, but still, when these execs send a message like this, I think it should be taken very serious, Inez.
And you'll likely see more executives sending this type of message, sort of coalescing around Jerome Powell. And not only that, but you are also seeing executives talking about these moves from Trump to sort of make everything affordable again. You had JP Morgan's CFO, Jeremy Barnum, that was talking about the credit card rate caps, saying that this would be very negative, quite negative, very, very negative, even though he couldn't quantify sort of the impact. You also saw ExxonMobil's Darren Woods talking about Venezuela being uninvestable. So not only are you seeing executives talking around this issue of Fed independence and the need for Fed independence, but also slightly pushing back a bit against some of these moves that Trump is wanting to make, that he wants the industry to make, companies to make, in order to make prices more affordable again.
President Trump using his trip to Detroit to slam Fed Chair Jerome Powell and the central bank yet again. Yahoo Finance's Jennifer Schonberger joining us here with the very latest. Jen.
Good afternoon, Josh. On his way to Detroit to give a speech on the economy, President Trump once again laying into Fed Chair Jay Powell.
Well, he's billions of dollars over budget, so he either is incompetent or he's crooked. I don't know what he is, but he doesn't do a very good job.
Later during a tour of one of Ford's factories, Trump called Powell, quote, bad in a lot of different ways, but he's bad because his interest rates are too high. Trump called today's inflation report on the CPI, quote, great, and says we have a great, strong economy. He also talked about renovations of the Fed's headquarters here in Washington, calling it the most expensive construction job in history, and that's just a renovation. Trump called Powell, quote, saying, Trump said either Powell said, quote, doesn't know what he's doing or he's worse than that, so hopefully he'll be out of there soon. Now, during his speech in Detroit, Trump said that he wants a Fed chair who will lower rates to allow the stock market to rally.
You announce unbelievable numbers and the market goes down because they know you're going to do everything possible. In the Fed, we have a real stiff in the Fed. We're not doing it anymore. We're talking about the head of the Fed, and I want somebody that when the market is doing great, interest rates can go down because our country becomes stronger. See, you view it differently. Our country becomes stronger, and therefore interest rates should go down, not up.
Elsewhere, St. Louis Fed President Alberto Musalem weighed in on the investigation into Fed Chair Powell, saying that Powell's video message Sunday night was very direct and clear. He stressed the importance of central bank independence and saying that making sure that politics does not get in the way of monetary policy allows more stable prices and maximum employment. Josh?
All right, great stuff as always. Thank you, Jen.
We have some great things happening with housing, as you know. You saw the $200 billion buy-in on bonds and mortgages. This will include a ban on large institutional investors buying up single-family homes all over the country and making it impossible for people to buy a home. And I've also announced that the U.S. government is purchasing $200 billion of mortgage bonds to bring down mortgage rates, and it's had a huge impact. It's already started. And just last week, the average 30-year mortgage dropped below 6% for the first time in many years. It's coming down very rapidly, and that's not with the help of the Fed. If I had the help of the Fed, it would be easier. But that jerk will be gone soon. In addition, I proudly called for the credit card companies to cap interest rates at 10% for 1 year because they're getting 28 and 30% and 32%. And it's unfair. The rates are way too high.
Governor Barr, thank you so much for sitting down with me. It is great to have you on Yahoo Finance.
My pleasure to be here.
I want to start the conversation with the grand jury's subpoenas that were served to the central bank by the Department of Justice and the investigation into Chair Powell. How did you learn about it? And when you did, what was your reaction? How did you feel? How do you see this?
Well, I think Chair Powell's statement from last Sunday was clear and direct on this point. It is an assault on the independence of the Fed, as was the earlier assault on Governor Cook. And I think these are just examples of the ways in which the independence of the Fed is being challenged. And I want to assure your listeners that we are acting only for economic reasons. We are acting only according to our congressional mandate. That's to make sure that we have price stability and maximum employment. That's what we've been focused on all along, and that's what we will stay focused on.
Are you worried that the independence of the Federal Reserve is under threat? And will you personally take steps to protect that independence?
As I said, we are acting only for congressionally mandated reasons. We're acting only in order to assure maximum employment and price stability. That's what we have been doing. That's what we will be doing. And the best way to demonstrate that to the American people is to do that.
Let's talk about inflation. We got some new readings on inflation this week. CPI on a core basis has been sitting at 2.6% for the past 4 months. We also got some readings on wholesale inflation. How are you looking at inflation now, as well as specifically the impact of tariffs on prices? And how much signal are you taking from the data now, given that we are still seeing a bit of a lingering impact from the government shutdown?
Well, the recent inflation data reinforces the concerns that I've had that inflation remains elevated. In core PCE terms, it's been hovering at about 3% over the last year. Services prices inflation has started to come down. Goods price inflation has been rising. Those are kind of offsetting. The balance is that inflation has been too high over the last year. We had a period of time where we made substantial progress from 2022 to 2025. That progress right now has flattened out, and we need to continue to do the work necessary to bring inflation all the way back down to our 2% target. Tariffs are having an effect on prices. We're seeing goods prices rise. The question is, will that be a one-time event where they rise and then they're done rising, and then we'll start to see inflation fall back towards our target? Or might we see persistence of that? And that's really what I'll be focused on the inflation front.
And what's your perception now? Do you see a risk of inflation becoming persistent, especially when you looked at the Beige Book and we saw some of the anecdotal evidence there when you looked at the PPI report?
Well, I do think we're going to continue to see goods prices rising in the early part of this year. I think a reasonable base case is that price increases stop going up once tariffs are fully incorporated into prices. But there's a significant risk that they don't, and that's the risk that we have to watch out for. So we're looking at the labor market, we're looking at the inflation side, we're balancing those risks. I think right now we're in a good place in terms of our interest rate policy to be able to take some time and really assess the inflation effects over the course of the next year.
I do want to get to the path on policy, but you also mentioned the job market, and the Fed cut rates 3 times the tail end of last year on concerns about the job market.
Right.
We got the December employment report. The unemployment rate dropped to 4.4%. Do you think things are stabilizing now in the job market, albeit perhaps at a lower level?
The job market does appear to be stabilizing. It's a little early to know for sure. We're still working our way through the data. It'd be useful to have some more data at the early part of next year to assess that. As you said, it's stabilizing at a very low level. So if you look at net job creation, it's hovering close to zero. The reason that the unemployment rate has stayed low and has stopped going up is that labor force growth is also very close to zero. Both those numbers might be a little positive, they might be a little negative, but if you think about it, we're not seeing a lot of dynamism in the labor market. On the positive side, it's a very low firing environment. We're not seeing a lot of layoffs of significant size. But on the downside, we're not seeing a lot of hiring. We're not seeing a lot of net new job creation. And so when you have that kind of low level of activity in the labor market, that does present a risk going forward that we need to watch carefully.
When you look at both sides of your dual mandate, are you more worried about inflation now versus the job side, or how are you looking at things now?
I think the risks are pretty much in balance. That's why I think that we're in a good place in terms of interest rate policy to look at those risks going forward. A reasonable base case is that the labor market is continuing to stabilize and that inflation will continue to come down to 2%. But there are risks to both sides of the mandate, given the low level of job creation, risk to the employment side, given the potential persistence of inflation, risk to the inflation side of the mandate. So I really do think we're going to have to take some time to really assess the incoming data. Really until the spring, we're going to have effects of the government shutdown playing into biases in the data for technical reasons on both the employment side and the inflation side. So we have to try and make adjustments for that. We need to treat the data, with some caution, and that will play through really into the spring.
So we're less than 2 weeks away from your policy meeting. You said you're in a good place with policy right now. If the meeting were tomorrow, would you hold rates steady?
Well, we always take things on a meeting-by-meeting basis. We still have a couple weeks till the meeting. I would say that I think we're in a good place on policy. We can take some time to make a judgment about how the economy evolves, how the data is evolving, what the forecast might look at, the balance of risks. But right now, I think we're in a good place.
Looking farther out towards the end of the year, I recognize we're in January. A lot of things can change. But do you perceive any adjustments to the policy rate, perhaps later this year, any rate cuts?
Well, I don't think it makes sense to lock in. We really need to know what is the data telling us and how is our forecast evolving, how are the risks evolving. But I think we can take some time really to assess the incoming data because our policy is in a good place. It is balancing both of those risks, I think, quite well. Right now, we're in what most people think of as the wide range of neutral. Mm-hmm. And so it's really important for us to be careful to take our time to get it right.
How restrictive do you think you are right now?
We're really in the range of neutral right now. Mm-hmm. So,
okay.
You can think of estimates around that. But
okay. Sort of switching gears, President Trump sent to announce a new Fed chair soon. We know that he wants someone who is in favor of lower rates. How do you see the dynamic of a new Fed chair playing out with the rest of the committee? Do you see any shifts to the Fed being able to act independently?
I think that the committee, the FOMC, is set up in such a way that a new incoming chair, like any chair, has to get the trust and confidence of the whole committee in order to make changes in policy. So the chair has to act based on data has to act based on reasonable forecasts and an assessment of those risks in a way that convinces other members of the committee that moving or not moving is the right thing to do. So the checks and balances that are built into the system will keep the Fed independent and focused on our goals.